So this is our halftime report. It's a little late because it's already almost the end of August, but there's been a lot going on, and it was kind of hard to keep up because things kept changing. But we'll go ahead and get started now. Mary, I hope I'm on the right channel, and I hope everybody can see this. Great. Okay, so these are just some disclosures that we need to read here. No problem. And questions. If you can see, I guess you can scroll. It's different for everyone, but I think for most people, it's at the bottom left of your screen. If you scroll down there and you see maybe a little question mark, you could probably send me a question, and hopefully I'll get it. It'll pop up. I'm still new to this, but if you have a question, go ahead and send me a question. I love questions, so we'll go ahead and get started here. So today's agenda, we're really just going to talk about what happened on the first half of this year so far. A lot has gone on, and we were kind of expecting a lot of what has happened, so not really a shock to us, but we'll talk about what happened, and we'll talk about what drove the equity markets, and then we'll talk about some of the things that we're expecting sort of in the next part of the year, next half of the year. So lots of interesting things. And in fact, if you're watching the market, you can tell that it's down right now, about 450 points. Powell just gave a speech out in wherever they are in Jackson Hole. And, he basically is saying the same things we've been saying, is that they're going to have to raise rates in order to fight this inflation, and they're going to continue to raise rates, and there will be some pain for some people. So it's kind of what we've been expecting. Hey, Lynette, great to see you. So we see what happened the first half of the year, and obviously you can see the CPI, which is the Consumer Price Index, came out, and it was 7% year over year. That was on January 12th. And the thing about inflation is that we've been through this many times before. Whenever there's inflation, there's an assumption that the Fed is going to raise rates, and they almost always do. And they raise rates because, well, they've had rates artificially lowered for too long. And that's part of the reason we have inflationary pressures right now. And we'll talk more about that here in just a second. But then, of course, in January 26th, the Fed surprised markets with talk of shrinking its balance sheet. So when one of the ways that we have inflation is when rates go down too much, people borrow a lot of money, and that creates new money. The other way we have inflation is when the Fed buys treasuries from the Treasury Department. I'll show you a slide on that in a second, but essentially what happens is that's their balance sheet. Those treasuries go on the Fed's balance sheet, and when they want to unwind that balance sheet, essentially they're destroying money, which is good. We don't want them to destroy money because the creation of money is what's been causing all this inflation. So, but when you have a contraction and you have reduction in the money supply, at some point there's a sort of a stop, a hard stop, and stocks will drop, and it happens almost every time. So that was a surprise. Then February 24th, of course, Russia is going to invade Ukraine. For what reason, we still don't even know. But there it is, and it's still going on. So, winter is coming, and generally, historically, if you look at Napoleon and Hitler, when they were, in that area, the winter was really the only winter there. So March 16th, we had our first interest rate hike, more than what people expected. And then on April 12th, we learned that inflation has hit a 40-year high. But that 40-year high is based on old formulas, old math, which has changed in 1990, changed again in 1980. So really, if you go back to the old math, our inflation is higher than it's ever been, at least since we've been checking it since the Great Depression. Okay, May 4th, the Fed hit us with a 50 basis point rate hike. Normally, if you remember, they generally will do it 25 basis points at a time. They hit the first one with 50 basis points, but then subsequently we've been having 75 basis point rate hikes. So that's one of the reasons the market's been very jittery lately. Now, let's talk about last year. We were here last year. We did the halftime report 2021. I showed this exact chart, and what I said was, is this something that's sustainable, right? And most of you agreed with me and said, no, that's not sustainable. Well, guess what? It wasn't. It's not sustainable, and it's still not sustainable. We've had a dead cat bounce here recently. People are very, very hopeful that the market continues to go up, and there's a whole generation in the market right now playing their 401k plans or whatever they have left of them, and they've never seen a down market. They were in high school or in elementary school when the 2008 debacle happened, and now they're starting to learn that things can go down, and they can go down dramatically. There's no warning. And we've had a great market run for a long time besides the pandemic. And honestly, it is a bubble. So we have to expect that. So if we go back and look at the NASDAQ again from last year, the 2021 halftime report, I asked that very same question: is this sustainable? I mean, that looks exactly like a mini or a very large 2000 run up. Look at that run up right there from 1999, 1998 to 2000. And then we had a sort of a stagflation, and a while there from where we hit the peaks back in 2000, it was all the way to basically 2015 till we got back to where we were. And of course, during that period of time, we had very, very low interest rates and a lot of stimulus. I'm going to show you that in a second. Again, the reason we have inflation today. But you can see, is that sustainable? Was it sustainable back in 2000? No, it was not. Was it sustainable then in 2019, 2020? No, it was not. And this dead cat bounce, is that going to be sustainable? I suspect it will not. So these are all reasons that we've been very conservative for the last couple of years, that. And the reason that we are still conservative because we're expecting a downward trend in stocks. And as Jerome Powell just finished saying, they're going to continue to raise rates. We know they are because inflation is so bad. So, we're really between a rock and a hard place here. Do we want to have inflation, or do we want a stock market crash and go into recession? Well, we're choosing recession because we already have inflation. And at some point it has to stop. It can't keep going. So let's look at what drove the equity performance then. Let's go all the way back now to 10 years, back to January 2012. Remember, we were still coming out of the 2008 housing crisis, and you can see that a lot of the indicators here were red, a lot of them were yellow, some were green. Obviously, interest rates were low, inflation was low at that time, energy was not extremely expensive, monetary policy was very accommodative with 0% interest rates, credit was available. Because remember, after the housing crisis, banks didn't want to loan, but it took a while. When we got to 2012, they started loaning again. So housing, mortgages, but if you look, at volatility and fiscal policy and the political environment is always red, it seems. So you look at the political environment today, it's still red. But in any event, if we fast forward now to 2022 in January, we can see that a lot of these indicators have become green. This is really where we hit the top of the bubble. And at the top of the bubble, everybody's happy. Everything looks rosy. Everything looks great. And no one ever suspects that it's going to collapse. But that's when I get my most nervous because I know how this thing goes, and it's cyclical. So you can see here in 2022, at the beginning of the year, we still had very accommodative monetary policy, which means that interest rates were low, and there was plenty of cash, and we weren't as actively raising rates like we are now. Housing and mortgages, the labor market, consumer spending. Consumer spending has been one of the mainstays of our economy because 70% of our economy is based on consumer spending. And we do a good job at spending. We're good at it. And interestingly, one of the things I learned, and I was doing this presentation, was that during World War II, we had so many men and material in Europe fighting the war and in the Pacific, but all of our economy here had turned into a warlike economy, and we were building tanks and trucks and all that stuff. And so finally, when the war was over, we had all of this machinery, we had all of this equipment, and we had all these factories geared up for war, and we had all these men in Europe and in the Pacific coming home that maybe didn't have jobs now because we were in a wartime economy. So we had to think about what were we going to do? And we did. We pivoted from a wartime economy to a recreation economy, a consumerism economy. So those places that were building tanks and trucks started building recreational vehicles. And this is a true story. And so that's how we became consumers, because after World War II, we had so much extra material. We had so much consumerism that we had to find buyers, and so we became very lending free. So loans just went out to everyone, and everybody got loans, and everybody bought RVs and cars and new homes and lawnmowers, riding lawnmowers, and it was fantastic for a long time. But finally, we're going to have to pay the piper, and here we go. So here we are, May 2022. We've had some cracks in the establishment. Geopolitical risk, obviously, with the Ukrainian war, Russian-Ukrainian war, not very good. Inflation is obviously now shown its head. It's up more than 10% year over year. We'll talk a little bit more about that. Monetary policy, they're starting to get less accommodative, starting to raise rates. Interest rates are going up. Consumer spending is still strong. The labor market's still strong. There's a yield curve problem. In the yield curve, I'm not going to go into that a lot, but essentially it's when the longer term bonds are generally going to always pay higher interest than the shorter term bonds. It's like a CD. If you get a 6-month CD, it pays a lot less than a 5-year CD. That's what we call a normal yield curve. The longer out you go, the higher their interest rate. Well, when things get weird and interest rates start moving around, what happens, the yield curve can change and it can become flat, meaning that the long-term rates are paying the same as the short-term rates. So why would anybody want to go out on the long term? And they don't, they stay short-term. And that just makes common sense. But then all of a sudden, so many people go here instead of here that this drives this price up and this goes down. That's what we call an inverted yield curve. So that means that the longer term bonds are paying less interest than the shorter term bonds. So we want a normal yield curve where the longer term pays higher than the shorter term. And that's what we mean by yield curve, and that's what it means by inverted yield curve. And it just means things aren't normal, you better watch out. And that's where we are. Things aren't normal, you better watch out. So let's just take a look then at earnings, because corporate earnings, as I said, is the 70% driver of our stock prices. And most of that is based on consumer spending. And if you can see here, generally, the earnings per share, the price of the S&P 500 stock prices generally follow a trend right along with earnings per share. Now, here's an important point I want to make about rising interest rates. Rising interest rates, obviously, it's kind of the base rate of all the interest rates. So all of these corporations, they have earnings. That's good. They have profits, we hope. So they also have debt, and their debt in the form of bonds. And these bonds come due regularly. There's usually some due every quarter, usually every year, and then they have to reissue new bonds. Generally, they do that and roll the debt over. Well, you can see where I'm going with this. Higher rates are going to require higher debt service. So when we go, as those bonds mature and they roll into newer bonds, they're going to be higher rates. Those higher interest rates cost or come out of the profits of the corporation. So the corporation's earnings are reduced by the debt service. Well, less earnings relates to what? Lower stock price, just math. And that's one of the sort of intrinsic problems that people see when they start seeing, rising rates. So if we look at inflation and the inflation trend, it's obviously all who you believe and who you talk to, but even the core CPI, the one that they've already manipulated 2 or 3 times, is in the 7% range. That raises some eyebrows, as well as it should. But remember, this is the CPI, and this is something that is developed and tracked by the Bureau of Labor and Statistics, which is a government office. Now, if we go back to in 1990, the way we used to track it. So the Bureau of Labor and Statistics used to track consumer inflation. CPI used to look like this. This was the 1990 based model. And if you look at that, we can see that our 1990 based model is way over 10%, looks like 12, 13% there. So the red one is the current one, that's the official one, but the blue one here is the one that we used to use in 1990, what they call the alternative 1990 based model. You can see that's pretty high. It's not like we're making it up. This is the one that we used to use. We just didn't like it, or they didn't like it, so they changed it. Well, the one they really didn't like was the one they used in 1980, because we go back to 1980, and again, this is from Bureau of Labor and Statistics, we're just following the same calculation. Here's the official one down here, which says we're at 7%. Oops, that's bad. But look at the one that we used to use in 1980. See, they started over here at the same, we're 15%, but now we're back up over here, what, 16, 17, 17.5% based on the 1980 formula that we used. So inflation is real. And if you go to the grocery store, or, you know, lately gas has come down a good bit, so that's not a good example. But if you go out to eat and you go to the grocery store, you go anywhere, you know, do anything pretty much, you look, buy a used car, prices are high. They've been very high. And I'm going to talk about the difference in prices and the difference in inflation, because they're two different things. So let's look at the components of inflation. What has, you know, which one of the, what are we looking at here? Well, the green portion here is energy. So oil, gas, things like that. Energy has gone up a good bit. New and used vehicles, that's the red, that's gone up a good bit. Food at home, well, we all know that's gone up. Just go to the grocery store, it's incredible. I think it's like $1 or $2 for one avocado. There was a shortage on avocados as well. So there's a difference again between prices and inflation. But what we're experiencing today in America is both. We're experiencing inflation, and we're expecting price increases based on supply and demand and the supply chain shortage. I'll talk more about that in just a second. And then that just, you know, all the other things that you do, TV, cable bill, going to the movies, things like that, restaurants, hotels, transportation, obviously that's gone up, you know, and oil moves a lot of these things. So shelter, your housing, you know, those have gone up. I've been reading where apartment rents are all-time high, skyrocketing and stuff. And it's just really hurting middle class, really hurting the lower class, and it's killing our middle class. Sorry about that. But if you just look out there in the real world, you know, you just walk around and do your normal daily thing, you'll see that there's inflation everywhere. I mean, here's, you know, this price has been changed. It's too expensive to actually print the signs. It's like the post office. I mean, our stamps are no longer have numbers on them. They're just, you know, forever stamps because they change so frequently. And when I asked everyone in the class yesterday, we had about 50 people there, and I asked everyone if they knew what the price of stamps currently were, and we could not have come to a consensus. I think the high was 60 and maybe the low was 55 or something. So, but we still don't know, and we didn't walk away with an information. But here, I don't know if you ever go to Roasters, Katrina, maybe you remember we used to go there. You know, you used to get those dinner rolls and cornbread that came free, you know, just part of the meal, but no longer due to inflation, can't get any more rolls. It's interesting too, because if you do buy the rolls, you have to buy them. They're not that expensive, I don't even know, but so few people buy them now that when you get them, they're not fresh and warm like they used to be. They're kind of cold and hard, so you don't even want to buy them anymore. Too bad. But this restaurant here, they gave up. They just gave up. I mean, the prices were changing so much that they just gave up, and they look like they need a new sign anyway. But you know, inflation, rising prices, or price changes are not the only way we see that. These manufacturers are getting really creative in the ways that they reduce product. So, you know, this is the same price for what I would call the same thing, but obviously we went from 16 ounces down to 12 ounces, right? So if I do $1 per ounce, that's a massive increase in the price. So you see it all around. If you start looking for it, you'll see it everywhere. You see a restaurant, so you order the same thing, price is the same, but maybe there were 2 pieces of chicken on it and now there's just one. Or maybe that was one big piece of chicken and now it's just a smaller piece. And I experience that all the time. And I guess I shouldn't look for it, but I do, can't help it. So let's talk about that, the difference in inflation and in price increases. So first off, let's be very straight about this. Inflation is very simple, okay? Inflation is simply more units of a currency that are in existence. So if you have a currency that's already in existence and you just print more of them and more of them and more of them, they will all devalue. I mean, this is factual, this is scientific, this is proven. We have seen this 1,000 times over. We've seen it for thousands of years. Obviously, the most famous instance is the Weimar Republic, Germany, after World War I. And we're seeing it now in Venezuela, we're seeing it in Argentina, we're seeing it in Chile, almost South America they just can't stop themselves. They need to all go on We all need to go on something that no one can print, but because just yesterday, the dollar went to parity with the euro. Well, as much as we've been printing, they've been printing more. So everybody has been raced to the bottom, which really should bounce gold and silver up. Okay, so that's inflation. All it means is there's just more currencies out there, and they're all worth less the more that you print. I asked people yesterday what's the most expensive painting in the world, and we all agreed it was the Mona Lisa. And it turns out it is the Mona Lisa. We all think. So does Google. And I asked them, well, what if Leonardo had painted 4 or 5 of them exactly the same? Would it be the most expensive painting in the world? And you see where this is going. No. If he had sat there and just cranked them out, and he had 50 or 100 Mona Lisas, they wouldn't be worth nearly what that one Mona Lisa is. Why? Because it's one Mona Lisa. You can only see it in one place in the world, and that's the Louvre, right? And no one else can touch it. No one else can take it, and you can barely see it yourself because there's always a crowd in front of you. But that is the Mona Lisa. It's rare. There's one. That's it. There'll never be another one. And if that one's gone, it's gone forever. So if you have Mona Lisa inflation, you have a bunch of Mona Lisas. Well, you have Mona Lisa inflation, right? It's not the value that you would want. Now, price increases are different. Price increases are based on supply and demand, right? You have a decreased supply, you have an increased demand, the price is going to go up. You have a decreased demand, you have a lot of stuff, but you can't sell it. What are you going to do? You're going to have to drop the price. That's just how it goes. Basic Economics 101. Now, the other thing that happens, obviously, we've learned this, and I'll be honest with you, I don't think any of us really knew how important the supply chain was, or maybe how tenuous it was, because when we've had you go to the grocery store even now and look at the baby formula. There's very little baby formula up on the shelves, and the price of the baby formula is outrageous. I feel terrible I can see poor people going in there looking at the baby formula, looking at the price, and just like feeling terrible. I mean, it just breaks my heart. So I hate that. War, pestilence, Armageddon, all these things will create price increases. Obviously, with the Ukrainian situation, the price of natural gas is gone up, and this winter that's coming is going to be rough on the Germans. It's going to be rough on Northern Europe. So they better get ready, because they're going to be paying higher prices if they want to stay warm, and they do. Okay, but let's just take a look at lumber. Remember, lumber just went really crazy after the pandemic. Well, you can see here's the price of lumber. This doesn't have much to do with inflation. There is some inflation here. I think the general trend of the price increase is probably inflation, but the price increases don't have to do with inflation. It has to do with the supply chain. And the other thing is demand. Remember, with the pandemic, everybody's stuck at home. Everybody's looking at their walls. They're like, oh man, I want to change this kitchen. I want to change these cabinets. I want to change this hardwood floor. We did that. We put in hardwood floors upstairs. So, what did that do to the price of lumber? Well, increase the price. We had a lot of demand, and the supply had remained the same. And even if we hadn't had a supply chain issue, the price of lumber would have gone up simply because of demand. But we did have a supply chain issue, and as you can see here, it created a pretty volatile market for the lumber market. But it's starting to settle down now, but still, lumber is pretty high. Okay, so how does this happen? How does all this money get into the money supply? Well, it goes through the Fed. Okay, the Fed is the culprit behind all of it, and ultimately the culprit is Congress, because Congress just can't stop spending money. I mean, it's not a big secret that if you spend more money than you have, that you go into debt. And then when you have debt, you have to pay the interest on that debt. And the more debt you have, the more interest that you have to pay, which takes money out of the money that you already have. Then you have to borrow more money to pay for that money. And then it's just a cycle that keeps on going. But I can't even talk about how angry I am with Congress and what they've done with our economy. But here's how it works. You've got these two things. You've got the Treasury and you've got the Fed. And I asked the class yesterday, how long has the Treasury been around? Well, it's been around since the beginning of the country, right? 200 or 300 years, since 1779. Okay, well, how long has the Fed been around? Well, the Fed is only about 100 years old. It was 1913. That was the Aldrich Act, Senator Aldrich Act, but it didn't go through. So they had to try again, and they renamed it. They renamed it the Federal Reserve Act, and that went through. It's just amazing, like the USA Patriot Act, right? So you have the Treasury and Congress spends too much money. We've got to spend $1 billion over to Ukraine, or we've got to spend $1 trillion on, fixing the economy, or the payback professional payback plan. So the Treasury goes to the Fed and says, "Hey, Treasurer, here, Fed, I've got a whole bunch of treasuries here that I just printed up. Okay, they're just paper, really. It used to be paper. Today it's just electronic. So here's a whole bunch of treasuries, Fed." And Fed says, "Okay, here's a whole bunch of dollars." And those used to be paper too, but now they're just mostly electronic as well. So they exchange. So here's the treasuries that we just created, and here's the dollars that we just created. So those dollars that they bought those treasuries for are just created out of nothing. It's not like Grandpa. Grandpa used to buy treasuries. He had to work for that money, pay taxes on that money, save that money, risk that money, invest that money, and then pay taxes on the investment. So this was just something that was completely created. And this one group, the Fed, is the only people that have the license to do that, even though the rest of us have to work and save. Okay, so once that happens, the Treasury now gets these dollars, and then the Treasury sends those out to Social Security, defense spending, foreign countries, Ukraine, wherever it may go, the public, Medicare, Medicaid. Medicare and Medicaid, Social Security is 70% of our budget, at least 2/3, and those expenses are going nowhere but up. I mean, I'm telling you, I'm not trying to depress anybody, but if America walked in and America was a financial planning client, and America came to me and said, "Hey, what do I need to do?" I would say you need to file bankruptcy because you don't have a chance. Okay, so here is what we call M3, monetary 3, which means it's got all the money out there in the world in your pocket and checking account, money that's in foreign countries. And essentially, you can see these numbers over here are very, very large numbers. And we were at about we were at 4 trillion in about 1996 for the Olympics, right? And we were 8 trillion right about 2010. And now we're $14 trillion more since that time. So in 12 years, we've managed to create an additional $14 trillion. So essentially what that did was dilute all this other money that had been created. And that's the money that you worked for. This other money, we just printed and just basically stole that value right out of your pocket. So thank you. and get this, it gets even worse. So here we are since the last 18 months, basically, and I don't even think I've got them all here. We've done the American Recovery Act for 1.9 trillion, 550 billion for the Infrastructure Investment and Jobs Act, and the roads in Brookhaven are worse than ever. CHIPS and Science Act, 280 billion on that. And get this, we just passed another reduction act, the Inflation Reduction Act. We're going to spend money to fix our problem of spending money. Folks, I don't know what to tell you. I don't know what to tell you on this. So here we go. In the last 18 months, we've gone through another $3.5 trillion that we do not have. We just don't have it. And so what do? We just print it. And what does that do? Well, that takes it out of the mouths of poor people and people that are on fixed welfare and expenses. Inflation reduction. I mean, here these people draw comics. These are political comic cartoon drawer artists. Okay, Gary here. These guys get it. They get it. You've got Congress. These are senators, and they don't have a clue. And these guys draw cartoons, and they completely get it. I didn't have to go very far to find several cartoons that really made the point well. So, we're not building back better. We're building back broke. And that's not just this administration, and it's not just Democrats. It's Republicans too. It's all of them. So, in fact, believe it or not, we actually had a balanced budget back during the Clinton years. And I'm not pro-Clinton. I'm not anti-Bush, but during the Clinton years, we had a balanced budget. I don't know how it happened, but it did happen. Then what do we have? 9/11, and the next thing you know, we're in Afghanistan, and then we're in Iraq, and then that's just a few $1 trillion later. We're down this path. So it's not like the Republicans are innocent of this, and it's not like the Democrats are the only one. They're both. They're all guilty. So I say get rid of them all. And we need term limits. God knows we need term limits. These guys stay in there forever. They become I got to get up my political soapbox. Labor markets. Let's take a look at the labor market. Well, obviously, during the pandemic, there was a lot of unemployment. Since then, we've had the PPP, Paycheck Protection Program, which has, kept everybody kind of floating without everybody filing bankruptcy. But that was a lot of money that went out, and a lot of it was probably corrupted away, I'm sure. But obviously, wage growth is still, the labor market's still pretty, I would say it's still pretty, there's still a lot of people out there that are not happy. There are a lot of people out there that are working 2 or 3 jobs just to try to make ends meet. There are a lot of people that don't have 401ks, that don't have health care, that don't have the stable employment, and so it's a lot of people are transitory. People are changing. You see people moving all over the place. I mean, if you're in Georgia, you see in Atlanta, we see New York plates, we see Texas plates, California plates, New Jersey plates, Illinois plates, and they're coming here from everywhere. So I'm hoping they'll go back soon because traffic is terrible, but they're here. Consumer sentiment obviously has dropped a good bit. Obviously, the market drops, consumer sentiment drops. So that really means nothing except that, well, this is what we expect people to maybe shop a little less. So it is sort of a cyclical situation, and people shop less. We have corporations have less earnings. Prices drop, stock prices drop, 401ks drop, people don't feel as good, and then they shop less. So it is kind of a self-replicating cycle there. China, China's been in the news a lot lately because there's a saber rattling over the Taiwan problem issue, but no one around their whole sphere there is very happy with them. So I don't know really where they fall in. If it were me, I would just put a 20% tariff on all China activity, and then it would move to other places. I mean, when I was growing up, we didn't get things from China. Everything came from Taiwan. Remember that? Now you go and everything's from China, but things are starting to come from Vietnam, Cambodia, and some other places. And I think those countries are probably going to be our future, maybe even some countries in Africa. So we'll see. The Russian invasion, we talk a lot about this, and everybody wants to know, well, how does this fit in? I don't know that it fits in so much anymore. Everybody's kind of used to it now. It's kind of drug on. I'll tell you where it does fit in, though, and that's Europe. So if you live in Northern Europe, you need to be thinking of another way to heat your house. The energy costs that are coming down the pike, it's going to be interesting to see how Putin handles this. There's going to be further stress, obviously, in the global supply chains, food costs, because Ukraine is the breadbasket of Europe, really. Lower economic growth across the world, and just unsettled global economic order as we can see this. And obviously, I think the Russian aggression has probably emboldened China somewhat. I think most people would agree with that. Hopefully, we won't have any consequences from that. And I really hope this solves itself soon, because I feel absolutely terrible for those poor Ukrainians. I mean, it's just horrible. So going forward, what are we going to look for? Well, eye on inflation. Well, that's in the news, and Powell just hit on it today. So they're going to continue to raise interest rates. Corporate earnings are probably going to disappoint because people are not feeling as great anymore, and they're probably going to spend less, and higher interest rates means higher debt service, means less earnings. So it's kind of a cyclical thing again. Bond yields trend higher. Well, when would bond yields trend higher? Well, they already are. New bonds are going to have to pay higher interest rates. So then the old bonds that are maturing are going away, and new bonds are going to pay higher interest rates. Now, the other side of this is there's a bunch of people out there sitting on cash, okay? So money market accounts are slowly, not at the banks, but in some places, the money market accounts are going back up. I mean, you can find money markets out there for around 2% if you look hard enough. They're on the internet, they're not at your local bank yet, but they're out there. It's starting to show up. So those are good. Those are some good signs, at least for some of our cash savers, because I know there are a lot of you. Let's take a look now at the second half. I feel like I'm going over a little bit, but we're closing in on the end. Market forces for the second half. Gross domestic product has been up. Obviously, it was down during the pandemic, but lately it's been trending down. And that generally, shows that we are heading into a recession. And actually today just came out that we are officially now and technically in a recession. So congratulations, everyone. If you remember 1970, then and you were nostalgic in those days, then maybe you'll find some cheerful memories in lines at the gas station. Real gross domestic product, which is domestic product adjusted for inflation. Again, the inflation rate that we're talking about here is not the real inflation rate, it's the fake one, which is the consumer price index. But even then, we can see that there's been quite a drop off here, even though we were on a super upward trend. But you got to remember, all these upward trends are false, fake in a lot of ways, because of all the fake money, all the new money that's been out there. It's not fake money because you can really spend it, but it's just made up. Market strategists, these are what we kind of look forward to, what people are saying, the strategists out there. What is the market saying? What's the bond market saying? What can we expect? Well, we expect earnings to drop. We expect earnings to drop. And with that, we would expect prices to drop. What do we expect for inflation? Well, what would you expect from inflation based on the chart that I just showed you, where we printed $12 trillion in the last $14 trillion, excuse me, in the last 12 years? What would our expectations what should they be? Well, they should be that inflation is going to continue to go up, and it will continue to go up until something dramatic is done about it. And the Fed is raising rates pretty dramatically, but I don't think that's going to be enough. In fact, they're meeting today out at Jackson Hole, but the official open market committee meeting will be in September 20th, and almost certainly they're going to raise rates there. We know they are. The question is, are they going to raise rates half a point? Or are they going to raise it 3/4 of a point? Or, as some people are predicting, will it be 1 point? I don't think it's going to be 1 point. We're all kind of betting on 75 basis points because that's what they've been doing. But again, the talk of the town today was, inflation's bad. We're going to fight it. We don't care. There will be some pain. So just get ready. If we look at, where we are now, this is the Fed funds rate. This is the rate that they, mess around with. You can see that they were jacking rates up already before the pandemic hit. When that hit, obviously they drop us all the way back down. So the question is now, if we have another major crash, how far down can we go? Well, we go back down to zero. Well, in Europe, they went negative for a while. So are we going to go negative? Probably not, but we'll probably have to go back down to zero. Well, where are we right now? Well, we're about 1.75, let's say. And we certainly expect that to be closer to 2.5 by the end of the year, maybe even 3.25, maybe even 3.5. So we'll see. If we back out and look at over the last, I don't know, since 1955, but each one of these interest rate hikes, if you can see your gray lines here, Lynette, can you see those gray lines right there? If you can see your gray lines right here, those are recessions, okay? We had a little mini recession right here during the pandemic. But if you see what happens right before a gray line, we have a rate hike, and then we have a reverse, a sharp reverse. See that? Rate hike, sharp reverse. Now there would be a gray line right here, but it has to last officially for 20 months or 3 months back to back for them to actually put a gray line. But there was a market crash there, and there was one here as well. So what's happening is every time they raise interest rates, they keep raising them until we have a crash, market crash, and then they reverse it back down. Raise rates, oh, too far, market crash, got to go back down, right? Market crash back down, raise the rates. So that's the trend. That's what we're headed to. That's what we're going to see probably again, almost certainly. There's a 95% chance. Okay, so that's the Fed funds rate. That's what we're looking at. You can see we're on a rate hike, and there's no end in sight on that right now. So we're probably going to hit 2.5%. I doubt very seriously we're going to hit 5%, because you see, since Volcker came in during these periods, really jacked the rate hikes way up. Remember those days? Okay, since then, the rate cap that has needed, this is the important point. This is the rate that was needed to crash the market. Okay, and you can see that rate that was needed to crash the market is on a downward trend. All right, probably because the economy is so much larger that it takes less of an interest rate hike to create the type of dramatic drop that we need and looking for. So. Any questions there? Any questions? Do I have any questions? No questions yet. Okay. So basically, we're going to want to stay focused on the fundamentals. You've heard that before. You've heard me talk about the Buffett indicator many, many times. This is one of the things that we really look at when we want to get in or out, or we're looking to buy in. So you can see that the all-time high was 214%. That means it's 214% higher than the average mean, okay? And if we had the average mean, really, it would be under maybe closer to 88% would be the average. So we're at 214. That's not a good place to buy in. In fact, anything over 150 is probably a good time to sell. And again, there's always probably, because you could have bought right here at 150, gone up to 100, 214, and you'd have been a happy person. But you're dropping back down now. Now you're down to 177. Is that a good place to buy? No, because it's still an all-time high. If you go back to 2000, the dot-com bust, that was 159%. So we definitely need to be under the 150% before we start thinking about, buying equities again. And I would like to see us down here in the, closer to the 100%. And if we were under that, that would be even better. But by being even better, what I mean is the market even has to take a larger hit. And so as interest rates get higher, that's going to cut into profits, that's going to cut into earnings, and that's going to cause the prices to fall, and eventually the market will just drop. That's what we predict. Obviously, we don't know the future for sure. One thing that always kind of convinces me that, it's going to be okay is by looking at the intra-year decline. So this is year to year, and let's just pick on 1 year. Let's just pick on 2010. Okay, so 2010, for instance, it was down as much as 16% during that year at some point, but it finished a year up at 13. Okay, so you can see many of these years that actually finished the year positive, at some point during that year, almost all of them were negative, right? So you sure can't time the market. There's no way to do that. And to try to jump in and jump out, you're going to lose money. So the best way that we've discovered to do this is just to asset allocation. Don't get out completely. Don't get 100% into anything, but to sort of lean. Okay, so when we know that we're way up on the Buffett indicator, we want to sort of lean out of stocks. When we're way down on the Buffett indicator, we lean back into stocks. And that's really just the best way to do it, because there's no way you can actually call it completely. So we just like to lean. And again, one of the things you definitely have to do is tune out the noise, because if you base your investment decisions on what you hear on the news every single day, you'll lose. You will lose. I mean, mathematically, we have proven that. But for other people who just stay tuned in or stay tuned out, but fully invested, they usually end up doing better. So the people who don't watch the news, don't watch anything about the stock market, are healthier, they're happier, and they do better in investing. So that's the anomaly, right? Well, does anybody have any questions for me? Because I just want to say that I've enjoyed talking to you. I probably went a little bit longer than you probably wanted. I'll do my best next time, about 45 minutes. But if any questions, I'll try to get those out of the way right now. And I don't see any, so I must have done a fantastic job. Or either you guys just don't know how to ask questions. But I am here. You know how to send me an email. You know how to get me on the phone. And we'd love to see you in person. But I understand all of you are halfway around the country, and some of you are very busy. But hopefully I will see you in person before too long. And I really do appreciate you being with us. And please stay tuned, because we're going to try to do these more often. Thank you very much, and have a great day and have a great week.